All right, we're recording. So let me just check my calendar as well, because I do have a pretty tight schedule, but I want to make sure that we get through this today. All right, yeah, I got till 12:30. So I want to make sure that I cover everything that I can, because I think this is kind of, I think it digs a little bit deeper for why we're focused on the dividend stuff, because in the spirit of kind of higher picture views, I think it's important to focus like on stuff that we focused on this morning. Like if I go back and grab that graphic, that I put in the chat this morning. Let me grab this. It's a little bit messy, obviously, but you get what you get. There is a strategy that we need to kind of obey if we want to make our portfolios grow in an efficient way. So let me just get back to the chat here. So in order to do that, we just need to figure out what we want to do. First off, that's always the first step. We need to figure out what are we going to do, and then how the hell are we going to get there, right? So let me pull up the chat here because it keeps closing on me, and I'm not sure why, but I'm having technical issues here. So this morning we kind of very briefly went over, the psychology of, increasing and kind of throttling a speculative allocation within a portfolio or within just overall finance. So the goal basically was to start with something like $500 an example, and then use a 20% threshold, so bringing it from $500 up $100 to $600, and then using that as kind of a ceiling and trimming the account back, taking that $100 and putting it into this stuff, and doing that a few times until we can kind of assess how we react to that $600 number, and to see if we're going to be able to remain disciplined and consistent and bored. And then if so, after a few iterations, after we've provided enough insurance by trimming and trimming and trimming and stashing and stashing and stashing, then we can level up and take the next progression up to the next tier, which is $600 up to $720 or whatever 20%. We kind of very briefly discussed the number of trimming iterations you take and the size of the range between thresholds that will dictate the kind of ratio that these two numbers grow at a scale within. So for the sake of not diving back into that too far, I kind of want to talk about where we should be putting that money for our determined outcome. So this is going to vary from person to person. It's going to vary based on where you're at in life, where you're at financially, where you're at age-wise, what your goals are, what your circumstances are. Not everyone ages the same. Not everyone has, no debt. Not everyone has some debt. It's very different from person to person. Some people live in different areas of the country and different parts of the world, so your income is going to change, and so are your needs. So obviously, up until this point, because you are alive, you're not incarcerated or enslaved, I'm willing to bet that you figured out a way to survive so far. You haven't starved to death, okay? But that's not good enough. We want to make sure that we're thriving. So in order to achieve something, first we have to name it. So what do you want to achieve? Do you, are you 20 years old and you just want to grow a portfolio for the future so you can retire early and have some financial freedom and some discretion about, what you do with your life? Or are you near retirement? Maybe you had a good career, maybe you didn't, and that maybe is putting some pressure on you to kind of hit goals and try to perform. And or it's just a balance between growth and income, right? At the end of the day, I'm not going to go through all the scenarios of what could be happening within anyone's finances, but just understand that when you're investing, you are always balancing income versus growth. Okay, so income is the money that you take. Growth is the money that you make. So the more growth you have, the bigger your portfolio will grow. And the more of that you take out and put in your pocket and spend on things, that's your income. Okay. So effectively what we're looking at in terms of money is equity wealth. Okay. And wealth is just the money that you keep at the end after you've bought everything. So we're just going to keep that and stash and stash and stash. And that's what we do with the dividend stock. So if you're someone who wants to take a more conservative approach, meaning that maybe you're approaching retirement and you don't really want to be aggressive in terms of your risk and you just want things to be stable and pull in consistent income, then in that case, you're probably going to want to keep less than half the portfolio in dividend stocks. And this is a retirement portfolio. So we really want to focus on kind of how we're weighting things. And, by putting more than half of your money into dividend stocks, you are still subject to things like inflation. Okay, so we got to be careful with that stuff. There tends to be reliable income with the dividends, especially if they're high quality stocks. If you get a good, strong market, that's awesome. But when the market is not strong, if you're not hedged properly, or maybe your needs outweigh your income, you're going to run into chaos, and you don't really have that job or the ability to go out and earn extra income easily, and that will just disrupt your retirement, and then that puts you in a stress cycle and potentially risks your financial survival. So to avoid all that, we just control how much we have exposed to potential inflation, because that's always going to be the number one risk factor in the economy when you're investing. So where does the other half go, right? The other half to 60%. I'd say like 40 to 50% would be a pretty good weight, in my opinion. And it's disclaimer time. I'm not giving you guys financial advice. I'm just walking you through what I think makes sense for that specific type of build out. And then you guys can scrutinize it and determine whether or not it makes sense to you. Okay. So not financial advice. But I personally believe that, half or less of an investment portfolio could be pretty well placed in dividend stocks, and we'll dive into the actual dividend bucket here in a little bit. But beyond that, you've got bonds, and you've got REITs, and you've got money market things, you've got preferred shares, alternative investments. So it's not just dividend stocks, and that's not just what I want to focus on in the Rags to Riches series going forward. So, when you're dealing with bonds, obviously that is going to determine, that's going to depend on the interest rate. You've got CDs versus bonds, and one is up when the interest rate is high, and the other is low, and they just kind of seesaw back and forth based on the federal interest rate. So bonds are government secured. They tend to be more stable. And if you're dealing with investment grade bonds, you're probably going to do better off in terms of stability because you don't have that same volatility that you might in a variable interest rate on a CD, for example, which is, for those who don't know, a CD is a certificate of deposit. It's a type of savings account. Basically, you give your money to a bank, they hold it for a fixed term, meaning that you can't withdraw that money, and they pay you interest on that because they're using your money for other things like loans and things like that, and they're collecting money from other customers. So you get a piece of that as the interest payment. And bonds are just federally insured, or there's private bonds, but I'm talking specifically the government ones that are high quality, very stable, but the rate at which their yield grows and shrinks is going to depend on the economy. So just keep that in mind. But that's usually going to be about 30 to 40% of a portfolio if you're being conservative. Okay, you're going to want to shift off towards kind of the federally insured stuff so that it's more stable. And then a smaller piece, maybe 5 to 10%, would be pretty good for REITs. Everyone's going to always need a house. Okay, real estate is not going away anytime soon. But REITs are unique in that they have certain advantages, and they also tend to provide income as well as asset exposure. So if you get a really good set of REITs and you're dedicating maybe 5 to 10%, like a 10th or a 20th of your portfolio, a very small piece to REITs, you can typically keep things a little bit more aggressive. 90% of your portfolio or 80% of your portfolio might be, pretty stable. So you're going to want to, you got the stake, right, which is the stability. That's the solid piece, and then you can sprinkle REITs and money market stuff in there. Or cash or settled cash, just to make sure that you've got enough to kind of ramp it up a little bit. So it's not necessarily just succumbing to inflation. Okay. You're still going to outperform your bank account. You're still going to outperform a lot of 401ks. It's just, you want a little bit of acceleration in there. And then of course, anything that you don't put into things like REITs, you can put right into money market. You can throw it over into CDs, high yield savings accounts, or if your broker offers an interest on settled cash, you can collect that as well. But you always want to have a little bit of dry powder, especially for hedging, because you don't know what the market's going to bring. And especially with this kind of administration, this kind of geopolitical stuff going on, you're going to want to make sure that you're relatively safe. If you're sitting outside of retirement, for example, you're not going to want turmoil, because turmoil is good only when it's one direction. Okay. And it's rarely ever the direction we want. And then you can also get into like preferred shares if you want to have, guaranteed dividend payouts over voting rights, for example. If you don't care about voting in a company, if you're not a larger investor, preferred shares are the way to go, because then you guarantee that you get your dividend payout, and there's usually some other advantages that come with them. But that's for, again, just kind of speeding up the yield of that portfolio for your income. Now, inside the stock bucket, which is just your collection of dividend stocks, right? You're going to want probably a third of that, or at least I'd want about a third of that, a third to a quarter, to be the dividend aristocrats. Those are things like O and Maine, And the really stable ones that have a long history of increasing their dividend yield, that have been doing it for 30 years or more, right? So solid investments. That should be your foundation. A lot of those are going to be found in your consumer staples. Healthcare, not so much, but it used to be healthcare. And utilities. People are always going to need oil and energy, and as far as we can tell, until something changes. But people are always going to need utilities. And then about half of that amount, you typically want to put into high quality yield stocks. So those are stocks that have, like a somewhat higher yield, but they're still sustainable. That's like Johnson & Johnson, for example. Like, you're not shooting for the moon. They're not 36%. Dividend yields or anything like that. They're just stable companies that maybe don't have the best or the most well-established history of dividend payouts, but they're making a lot of money. They have the 3 golden criteria in that the company's making money, meaning the CEO is making company, and they're willing to share it with their board of directors, and their board of directors is willing to share it with the market. And we can identify that by looking at things like free cash flow and stuff like that. So if this is over your head, that's okay. I just want to make sure that we all understand that there is a ratio for each of the things that we put into a portfolio. So it's a very strategic approach. And then beyond that, you've got your dividend ETFs, and that's where you're looking at things like the SCHD and VOO, the Vanguard suite of ETFs. And that, by having those, you're being less company specific, and you're being less company dependent. So if you can get a yield of maybe 3 to 4% and dividend growth over time, I would choose that over just getting a high yield, right? And there's a time and a place for that. So the idea here is that you want to put larger allocations into companies that have a stronger history of dividend growth and stronger potential for dividend growth. And you want to put smaller allocations in companies that offer a high yield. And it's just like in speculation. If something's moving with a lot of volatility, if it's a small cap, fast moving runner, you want to commit small amounts of money because it's going to go over a wider range. There's going to be more volatility, more violence with a higher potential. And then for the more stable stuff, you want to typically use larger amounts of money, but you want to keep them much more stable. Okay, so it's that inverse risk hierarchy that we like to talk about. We're just going to apply it to the dividend side of things as well. And then, so in that case, any money that's not given out in dividend typically stays in the share price. So you can also kind of put yourself at ease in understanding that, because if you think about it, remember, every dividend that comes off of a share is just converted to a later cash payment, but the share itself is adjusted by that amount anyway. So if you don't take as big a dividend, it's just going to reflect in the share price, and the share price will go up anyway. And since you're holding them, you still get the same money. You just don't pay taxes on it. So I prefer stability and dividend growth over a higher yield short term because of those 2 primary advantages. So less tax burden and a greater share appreciation. And remember, once you get up into a certain tier, once that portfolio is big enough, especially if it's stable stuff, you can then take that to special lenders, and you can do things like use it as collateralized debt to take out, loans, and then that debt is tax-free. So as long as you pay the interest or dedicate a portion of that to something that can pay the interest, which your portfolio should already do, that you're just getting tax-free money for having money, basically. So there's definitely an advantage in doing this strategically. And again, if it's over your head or maybe it's a little complicated right now, that's okay. We're going to be building into all that stuff. But the idea here is that I just want to demonstrate the importance of having a strategy, right? And just understanding that there is a method to the madness here. Typically no, Tammy, but I am recording this one because I don't know if I'm going to post it, but I want everyone to at least have it. You guys can decide whether or not I upload it, I guess, at the end of this. I know I've gone over some of this stuff before, so I just want to make sure that we kind of get through it. I also have to keep an eye on the time because I do have to, I have a hard cutoff here at 12:30, but I want to make sure I get through as much as I possibly can because, again, this is the stuff that kind of frames why we're doing what we're doing, especially on the speculative side, and especially when it comes to trimming and keeping things in familiar ranges and putting it over into investments. So we're going to want to talk about, the cadence of rebalancing and tax obligations and things like that. So we'll get there. So typically with a conservative approach, you don't really want to mess around too much. I have a very conservative approach on my larger accounts. I look at it maybe once a year, I don't really do too much. I don't want a lot of activity. I just want to keep everything boring, because I know if I go in there and start making changes, it's big numbers, so my brain will definitely just do weird stuff. So I don't want to mess with it. As disciplined and as experienced as I am, I still know myself enough to know that I will probably just do something silly, and I don't want to do that. So we're going to say no to that. So I do it maybe once a year, maybe every 6 months. And it's mostly, at this point, it doesn't really involve changes. It's mostly just going in there and making sure that I'm properly allocated for the market environment, and that's about it. And I have a lot of ETFs, so I don't really worry too much about individual company catalysts. A lot of the dividend yield just kind of goes and sits there. I don't have to do anything crazy with it. That's what I use to pay the bills. So, all right. So now we've covered kind of the retirement approach. Okay. And you're going to have your number for either one of these. You're going to have your number. If you have clean visibility of your expenses and you understand your recurring and you've reduced your recurring as much as possible by picking up the phone, taking advantage of loyalty programs and all that good stuff that I've already gone over, you're going to have a number that you spend every month on your recurring expenses. And then you can add some padding for discretionary and incidental, right? Just extra spending and things that you want to do. Plus, anything annual that you might want to do, like vacations. You can come up with some number that applies to you for what you expect to spend over the course of a month or a year. And then you can figure out, at X rate of yield, based on any number of configurations that you have of a portfolio, you can figure out what your expected yield should be for the year. And then if it's greater or less than, you can offset that with speculation if you want to, but you don't have to. Or you can go out and donate plasma if you want to, but you don't have to. Or you can go get a transcriptionist job that you can work from home and kind of work whenever you want. There's all kinds of ways to make money out there. It doesn't just have to be the stock market. So if you're struggling with the speculative stuff, you can put a halt on all that while you practice and just don't risk any more real money. Well, you can just go out and get a guaranteed source of secondary income by doing things that are different, right? And that money can just sit there. It can keep collecting interest while you practice and while you go out and do this other thing. It's just a separate stream of revenue, okay? It doesn't have to be the end-all be-all, and you don't have to force it to work. But if you are on the cusp of retirement, or maybe you're past that, you're probably going to want to take a more conservative approach that focuses on income rather than growth when it comes to building your portfolio, okay? And I know that still doesn't meet the needs for everybody, and that's okay. There is a temptation to lean harder into growth, but just understand that comes with risks. I've seen a lot of retirees get involved with the stock market, and they've done the dance, and they get burned up, and then that's it. The last 30, 40 years of working and saving and scraping by and all that stuff just disappears, and it's not a good feeling. So if you're going to have risk, you need to make sure it's very controlled, and you want to make sure that it's that the importance of saving that money matters, because it's all fuel. Fuel goes in a tank, and that tank runs an engine. So if that engine doesn't have fuel, the engine will shrink, and its output will shrink along with it. So once you've got it to a certain size, you want to make sure it doesn't get any smaller. That's the goal. If you're younger, however, if you have more runway, or if you have more income to offset the need for that dividend income, then you can look at a more aggressive approach, more comfortably, I should say. If you're maybe in your 20s or 30s, or you're just getting out of high school, heading into college or the military, you have typically, as morbid as it is, you should expect a little more time, right? It doesn't mean you're guaranteed that. Nobody is. But you can typically take more risks. You can spend a little bit more on travel. You can spend a little bit more on comfort and lifestyle things. You're going to have more disruptions because you're just more active in life and kind of exploring the world. You're looking at potentially more, job instability, for example. You're just a little bit less stable in most cases for younger adults than retirees tend to be. Okay, you're still maybe considering buying a house, for example, where a retiree might already have theirs paid off. There's different circumstances for everybody. Somebody could have inherited their house. It's all circumstance. But so when you're building a portfolio as a younger adult, then you can take a little more risk. Then you can put maybe 85 to 95% into equities, and that's where you're looking at like the dividend shares and ETFs and things like that. So you can take a much more aggressive dividend approach, get a higher yield potentially, and then maybe you only use maybe 5 to 10%, if any, on things like bonds and CDs. Because you're not really going to want to tie up that capital for that long for a lower yield if you can accomplish the same thing with a bigger yield on the equity side. And we still want to typically keep some cash on the side, again, just to hedge, just to make sure that you have the funds available just in case, right? So in that case, that's typically why I just focus on the dividend stuff, because that's where like 90% of the money in most people's scenarios could and in my opinion should go, as long as they can manage the risk and they're picking only the highest quality stuff, like the dividend aristocrats, for example. So within that 90% dividends or whatever, we can put about half of that in domestic stocks in my case, or in my opinion. And that's going to be like tech stocks, like not Intel, not today, but like you can put it in NVIDIA. Tesla counts. It's a little aggressive, but I'd maybe use a smaller allocation for that. Apple, all the tech stuff that is domestic and growing, right? Because that's not going to stop anytime soon, in my opinion. And they both have definitive advantages over the market that you can articulate. So a company like NVIDIA, for example, they have everybody's balls in the salad shooter because everyone needs NVIDIA. They need the semiconductors that they provide, and that's going to stay that way because it's very, very difficult for anybody, especially a smaller company, to go out and develop things that can outperform and be outproduced for cheaper, right? And as soon as that starts to present itself, guess what happens? NVIDIA buys them at more than they're ever going to make anytime soon. So all these companies are just selling their tech that would usurp NVIDIA's advantage. They're just buying them out. So that's why I'm not worried about NVIDIA falling off anytime soon. And as soon as it does happen, I'm out. I'm not going to mess with it. But until then, they've got a chokehold over the entire tech sector. And I'm here for it because I know it's a cash cow, at least for myself. So anything innovative, you're going to look for M&A, so mergers and acquisitions, scalable businesses, things like that. Ideally, something that has more growth potential is good for long-term investments, but it's not necessarily a requirement. You want stability, but when you're looking at U.S. growth stocks, you just want things that are going to grow and have these kind of chokeholds on things, because those are the ones that are going to get the money. They're going to bring in all the revenue, and if they're managing that revenue efficiently, they should have a lot of free cash flow, which means they can do things like buy their shares back and offer things like dividends, things like that. So about half that portfolio is going to be U.S. growth stocks, and a lot of it's going to be tech at this point. And then maybe about a quarter of that or less. Sorry, give me 1 second. Just coughing. Sorry about that. They're trying to take me out. So about a quarter of that or maybe less, you're probably going to want to put into international exposure or emerging markets. And that's just because it's a little bit more risky. It's a little bit more dependent on other factors like tariffs, for example. And emerging markets are really subject to regulations. Like we've seen with Kalshi, for example, they just got banned in Massachusetts. Sorry, I had to drink. So we got about half of it into U.S., growth stocks, and about a quarter or less into slightly riskier international or emerging market stuff. And then you've got, maybe 10 to 20% of what's, if you want to, into kind of those burgeoning growth sector, small cap or mid cap stocks. Those are the ones that Austin and Lee really, really like. And those are a little bit more speculative in nature. They have more volatility. And maybe they're not going to be long-term holds. Maybe they're stocks that maybe you hold for maybe 2 to 3 years, and then you just kind of drop them when they peak out or when it's good enough and you find a better opportunity at a lower cost. But that's also where you get things like Tilray and other companies like that. Tesla itself was the same thing. It was an underdog stock and it was garbage. It still kind of is, in my opinion, from a fundamental perspective. But the market appreciated it because it filled a demand, and it filled it well. So there was plenty of money to be made. So you just have to recognize that there is potential for that higher volatility stuff and the explosive growth potential stuff, but that shouldn't be 90% of your portfolio, in my opinion. You want stuff that's going to outperform over a longer period of time, and then you can get into, kind of padding that with a little bit of stability, where you put maybe bigger allocations, maybe like 5 to 10% of your portfolio into the dividend growth stuff. And that's like Vanguard and Schwab and things like that are really, really stable. And you don't really care. Again, you don't really want to prioritize the dividend yield because you're not really focused on income at that point. You're not focused on cash flow. You're focused on the amassing of equity. You want the value of the portfolio to increase, and you want it to do that aggressively. And you also have to understand that you're going to see a lot of volatility. And that's where you're going to be the most tempted to do things like panic sell and and over hedging and things like that. So, if you have something like a Roth IRA, for example, that can provide an advantage because you're tax advantaged there. So if it is something that has a lot of dividend yield over and over and over again, and you've got plenty of time, maybe you're in your 20s. Sorry, I'm getting a message here. I'll answer that in a second. Then you don't really need to worry about, or you won't have to worry about taxes so much, because you can just collect all those inside your tax advantaged account, and all those capital gains hits don't really matter that much. And by the time those shares that you're holding are qualified dividends, meaning you've held them for a longer period of time, and you've held the shares for more than a year, then when you do sell them, they're going to be taxed at a lower rate anyway, and then you just have the fee if you need to withdraw before retirement from the IRA. So there's a strategic advantage in just offsetting those taxes, but you have to do it the right way, right? So again, I'm kind of topic hopping a little bit here, but I want to make sure everyone's under control of their intentions in the market. Like we're not all just here to trade low float crap and make a little bit of gas money, right? We're not all here to build a retirement empire either, or to establish generational wealth. Some of us are, and that's great. This is the kind of stuff that leans more towards that, but it all plays together at the end of the day. And then, in that situation, when you do have a lot of volatility and a lot of drift, and maybe your investments aren't performing very well, like maybe you grab some Intel as part of your U.S. growth stocks, for example, then you can kind of focus on rebalancing a little bit more ad hoc, but you don't want to just panic sell when something drops 2% or 3% or something like that. So there's a little bit of a difference in how much time you're going to spend participating and monitoring these. But the idea here is that you've got two different ends of a spectrum, and you have to figure out where you land between those two. So if you're near retirement, if you're financially secure, you're really going to want to focus just on income rather than growth. If you're younger and you want to be a little more aggressive, you can focus on growth if you don't necessarily need the income right now. So everyone's going to have this huge matrix of decisions to make because of their different circumstances, but everyone's path here should be linear, because you know exactly what your number should be for expenses. You know exactly what your goals are in terms of, do I want to buy a house? Do I want to change how I file taxes by getting married? Do I want to change careers? There's a horizon in front of you. Do you want to start a business? Do you want to, do you want to end up owing child support? So either way, at the end of the day, there's an expectation for how much money you should have to spend on a pretty recurring basis. And that shouldn't include a damaged lifestyle where you're starving yourself or just eating ramen, right? You want to be comfortable. And we've talked about ways to reduce recurring expenses and all that good stuff before. But when it's time to build a portfolio, I'm going to pull up Mirror again. You guys are going to hate me for this, but I'm pulling it up. I'm going to put it right in front of you guys again and again and again. When I talk about the investment allocation here, this is kind of the same thing that I'm doing right now. So financial security outside the market, this is going to be drastically different for everybody, but you should have a number. You should be able to develop a number that says, okay, every month I spend this much and I have this much in annual recurring, meaning that I've got yearly subscriptions to things, or I've got, tax burdens that I have to cover each year, blah, 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 right? You should be able to come up with a number, and then you should be able to work that into a budget, in theory, to the point where you can make consistent contributions. If not, that's okay. At least you know where you're at, but you should have a number, and then we can work from there. If you're able to make consistent contributions, or if you have over the course of your life, those go directly into a portfolio. And then that can be different accounts. I would consider 2 different quote-unquote portfolios to be part of the same portfolio in terms of your net worth, meaning that maybe this is a Roth IRA and this is a Webull cash account, for example. That still counts. I would still say that your overall net worth is the sum of these 2, okay? And then within this one, you've got to determine what flavor you want it to be. Do you want it to be income heavy or growth heavy, or somewhere in between, right? Most people are going to be kind of in between because you want exposure to catalysts. You want to take advantage of sector booms like nuclear and AI and things like that. So it makes sense that you're going to want to skew this allocation a little bit to weigh a little bit more heavily into certain things than others. Like healthcare, for example. I don't like the healthcare industry right now. I don't like the financial industry right now. Those are typically the 2 of the best industries to invest in this time of year and with these kind of catalysts, but I don't trust them. So I'm pulling back on some of those in terms of what I'm looking at intently, and or I'm hedging, a little bit more. But the idea here is that you've got some goal in mind and some way to achieve it, and then that will yield something, okay? And then what you do with that yield is going to usually be reinvestment. You're obviously going to want to trim some out to cover your life expenses and meet that number that we talked about. Everyone's got a magic number, like how much do you need to make in the market, and then that's going to scale. If I can't find that graphic again, but you guys remember the graphic with all the sawtooth and the circle and all the lines pointing at it. This ratio here, ratio of growth, is going to be determined by that number of iterations and the range of that threshold where you trim the account back down over and over and over again on the speculative allocation. And then that's when we can get into, X number of day trades is at certain percentage yield, at certain win rate, blah, 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 which is a skewed metric, but should also yield some consistent number, right? Because this is how banks do it. You don't want uncertainty in your finances. And you can also know that there is a definitive cost of doing that, and that cost can be used at taxes. And there is also a yield attached to that, which helps you combine the yield from the investment stuff, and then it ideally meets or exceeds that number that we talked about earlier. If it's positive, meaning it's greater than that number, you will have wealth. If it's less than, you will have a deficit, but you're offsetting it by having all this in play. And then you know exactly what that difference is. You can go out there and find other means to supplement that, and it doesn't have to be another job. It can be something that maybe you just invest in something outside the market, like maybe you're an angel investor or start up some sort of side business or something, and you just get kickbacks. Maybe you create some sort of intellectual property and you lease it out and collect royalties. I mean, there's all kinds of ways to make money on the internet, as well as out there in the real world. So it's not it's not out of reach, but you have to understand and accept that your portfolio plays one part. It's made up of many parts, but it plays one part in meeting that number. And without that number, you don't know how much you need to make. You don't understand the role that the market will play in your retirement or your long-term growth. So that's why I say it always boils down to financial security outside the market, because this is what determines what your goal should be, at least in my opinion. If your goal is to survive and you need income now, you're going to want to focus on stability. You're not going to want to deal with any risk. You're not going to be doing any individual companies if you can help it, other than in speculation allocation. For your investments, it's mostly going to be domestic and foreign ETFs, at a certain weighting, and you're going to lean heavily into bonds and CDs and high yield savings accounts and things like that aren't equity based, because equity involves exposure to inflation. So, and of course, company catalysts. So there is like I said, there's a method to the madness here. So I'm not just I'm not just saying, be financially secure outside the market. It serves a very deliberate purpose. And that purpose is that you will then understand what you need to accomplish with this engine. Does that all make sense? And yeah, Tammy, I'll probably upload this. If you guys want me to upload it, I will. Let me make sure I'm unmuted as well, because I sometimes do that. Okay. That would be awkward. But does that make sense so far? All right. Tammy says yes. Okay, good stuff. Snowflake says yes. I guess, I suppose. All right. And again, that's the driving force behind all this, is that you need to know how much you're going to need to survive, and then how much, like anything beyond that survival threshold is growth in terms of personal finance. So without knowing what that threshold is, you can't determine whether or not this is going to be an efficient use of that capital within the same amount of time. Okay? If there's a better way to use the same money that you'd normally commit to this, the stock market, that's going to return a more efficient result in a shorter amount of time, it makes more sense to go do that instead while you practice this, or while you do some research and build out this fantasy league dividend structure of a portfolio, and then take that money that you've made in a shorter amount of time and then slap it back into this engine that is now perfected. That's the goal, because at that point you should get closer to meeting or exceeding this number. All right, and then the speculative stuff, that just, you guys have seen, that ramps up pretty quick once it starts to compound. But this shouldn't be the main focus of anyone's portfolio. This is just icing on the cake that eventually drives that cake really far over time. But it's always going to be a ratio, because in theory, you know, and ideally in practice, we're trimming this over and over and over again, and taking those trimmings and shoving them up into the investment stuff. So it should always be a ratio. And as you increase the threshold on that ratio down here, the allocations, the trims get bigger, and this gets bigger at scale. So it should be like maybe a 1 to 1.2, for example, for each time you trim, if you put that trimming up into here at a 20% ratio. Does that make sense? I think I worded that a little bit confusedly. Hey, Elizabeth, how's it going? Newest medical assistant test graduate in the Discord. Snowflake had broth for supper. Oh no. All right, good stuff. So with that all rambled through, do you guys have any questions about the allocations versus the goals of an investment portfolio? I want to kind of take a break from the speculative stuff, because I think you guys all see the plan there and see that at least that works consistently, and that we can manage our risk much more tightly without serious consequence. But I want to make sure that the money that you make doing that goes to something mechanical as well. Because the speculation, it's all mechanical. Like I'm not making huge decisions. I'm just looking and seeing where these banks already are, the institutions, and then I'm just doing what they're doing, but I'm getting in and out along maybe one of their iterations, where they might do a dozen or more iterations along the same move. So I'm just catching a little piece. They're catching a bunch of little pieces. I don't need all those. I just need one. And that just adds up over time. It compounds pretty nicely. So we're not going to focus too much on that stuff, because that's pretty simplified at this point. But this part is a little bit more of an art, because you want to take a subjective goal of saying, I want to blah 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 blah, right? And maybe you don't have a fixed number in mind for that. Maybe it's a little bit more difficult because it's intangible. Maybe I want to travel more this year. Okay, where do you want to travel? How do you plan? Or what are some possible ways to get there, and what would you like to do? And then roughly how much would that cost? And then roughly how much would you need to make to offset that to where it's achievable for you? Maybe this year, maybe next year. And then is your portfolio going to be able to supplement that, or is it still just not ready yet? And does that portfolio structure align with your overall goal, not just this goal of maybe traveling a little bit more this year, but does it align with your overall goal based on where you're at overall? And then if not, then you know that your number is being exceeded, so you maybe just have to go find some other source of income for that particular piece of it, that may be a shorter-term goal. Because we don't want to derail this. And it doesn't have to be dividends. Like I said, if you're focused on income, not growth, you're going to really want to focus a lot on dividends. If you're focused on growth over income, maybe you're younger, you're primarily going to be in growth stocks, not so much dividend aristocrats, for example. So with that said, let me end the recording. If you guys don't have any other questions, I'll give you guys like another 10 seconds or so. Just put a 1 in the chat if you have a question so I know. Otherwise, I'll just end that recording. And let me also move my Discord over to the side here. And then it sounds like you guys want it uploaded. So let me end the recording. Thanks for watching, and I'll hang out in the Discord.